The trade this morning, not so prominent, has been with Chinese banks. And also of late, we've seen obviously a big sell-off led by Pinduoduo in the Chinese e-commerce space. I remember the day Pinduoduo fell 28% on the back of earnings. A lot of analysts said that it's a screaming buy for the stock because they're doing so well in terms of gaining market share. The business model is solid. The economics of the business are working well. And so to that extent, how do you look at the Chinese e-commerce sector?
Look, the Chinese e-commerce sector, very clearly, and I think in this particular specific case that you mentioned, we do think it was an opportunity where the market overreacted. The stock does trade on excessively cheap valuations, no matter how conservative numbers you put in terms of their operating margins, their growth outlook, their cash flow generation is very strong. Obviously, it's a very balance sheet light business. So, in that sense, it is a buying opportunity. One has to remember this is a very competitive space, and I think scale matters, and the likes of PDD have built up scale, which I think acts as a moat in itself, at least for a period till you get big competitors. It's interesting you mentioned the Chinese banks. And I'm reminded of the times when I used to cover these names as well as Korea. And Chinese banks just seem like the ultimate value trap ever, right? Just the way the Korean banks have become. But
really?
Maybe that's a discussion for another day.
Really? No, you could elaborate a bit more. We have about a minute and a half to go before we wrap up this discussion. I would want to understand that segment a bit more because, from what M has highlighted, the total return from these banks, which is basically the return on the stock prices, so the shareholder return, plus the dividend payout, would really tantamount. I mean, if BOC has started the whole cycle of paying dividends, and that would make it more attractive to get into these banks, even though a large part of their lending book is towards infrastructure and driven by state policies. I would want to understand a little bit more about the investment case here.
Well, or the lack of one, I would say. But look, I think the biggest challenge really here is when you trade at such low book multiples, when you have very high dividend yields, I think clearly the market is saying we don't have a huge confidence in your balance sheet, right? I think you touched upon it in terms of state-directed lending. Now, whether that's actually state-directed specifically or not doesn't matter. I think there is a lack of confidence in the balance sheets. And it's something that, we saw in Korean banks, I would say, quite a while back. I'm not saying that's the case today. And, it takes a while for that confidence in balance sheets to bring up. I think we've seen that in Indian state-owned banks, the PSU banks, a similar situation. So balance sheet confidence is super critical. You can keep reporting earnings, keep paying out. But if the market doesn't see your balance sheets as robust, then there's a question mark.